Efosa Aluyi joins us now. We're taking a look at oil prices. Efosa, how are you doing this morning?
I'm very well.
Yeah?
Thanks for having me.
It's good to see you.
Yep.
So oil prices falling as a result, I guess, of what we're seeing with OPEC Plus and these disputes that they're having based on output cuts, which apparently Nigeria, Angola are pushing back. What do you make of that development?
I mean, I think it's just around the fact that OPEC expects that members will be at a certain level of output because this meeting essentially was meant to look at the output situation and what the plan would be to end the year and then go into 2024. Recall that OPEC had essentially pledged to sequester about 5 million barrels a day. That includes the 1 million barrel voluntary cut that Saudi Arabia has done and about 300K from Russia. So the idea really is to get a sense of where everyone is in terms of output and to use the output that we've had over the last couple of months to make plans for 2024. But of course, the Nigeria story is well documented. All of the theft and all of that has really not allowed us to ramp up production to the point where we're comfortable with in terms of the output that we have with OPEC. So the point is that we cannot go into 2024 with these levels of output. It is important that we are able to get plans that will give us better output from this year going into next year. So I think that's the point of this agreement. The prices, crude oil prices, essentially dropped as a result of that. However, we've seen it recover. When markets started to figure out the fact that this issue was just around African producers, which are not very heavy hitters really in the grand scheme of things. So we've seen a recovery in crude oil prices since.
Now, we're hearing reports of Israel, Gaza, a possible ceasefire brokered by the Biden administration. So does that, if that comes to pass, do you see any impact on oil prices at all?
I mean, what that does is to essentially reduce the likelihood that we could get a conflagration of that crisis between Israel and Hamas, right? So if there's a ceasefire, it means that both parties are willing to sort of see eye to eye, maybe talk. So the risk that the conflict grows bigger or gets wider is significantly reduced, and then the risk obviously to oil prices is also significantly reduced. So this is a really good development. We, however, understand that the first set of hostages are not going to be released until about Friday. Really remains to be seen how things pan out on that front, but this is really a good development, not just for the crisis itself, again, by extension for oil prices.
Okay, to Europe now, Mr. Leguido, the ECB vice president, sharing concerns over rising debts, saying that he's worried about stress for banks. We can see this, I think, is from the Financial Times, bad debts, Eurozone, rising up to where the chart is, where you are standing right now. What do you make of those concerns as far as the ECB economy is?
I mean, not significantly different from what we're having in the US, for instance, right? If you look at the fact that the ECB has implemented its most aggressive monetary policy tightening since that, union came into being, 4.5% over the last year or so, obviously financial conditions are significantly tighter, right? Also, if you look at the US, you're seeing these tight financial conditions create problems for commercial real estate as well. It's the same thing that you're having in Europe. As a matter of fact, banks are having to significantly increase their loan loss provision. Barclays, for instance, has increased its, as at the end of H1 this year, increased it to about $1.2 billion, right? That's about twice what it did the same period last year. Santander of Spain increased by 17%. Deutsche Bank increased by 21%. So you're seeing banks making more provision, and that's just on the back of the fact that interest rates are higher. The expectation is that you're likely to see a bit more defaults, from that loan standpoint. As a matter of fact, for the commercial real estate segment in Europe, you have loans that are maturing between now and 2025. You're looking at a funding gap of potentially about $55 billion. Number one, property prices have dropped, right? So which means that, the equity owners would have to pony up a bit more money to be able to refinance. Interest rates are significantly higher, so that creates a bit of a problem there, so that's something that is a potential stress point. But I think that, the fact that the banks are significantly increasing loan loss provision and the fact that their balance sheets are, significantly healthier than where we were post GFC, and the fact that if you also look at, global banking landscape, European banks were essentially, almost unscathed. If you look at what happened with regional banks in the US in the spring, so I think that it's a valid concern, but I believe that, the banks in Europe are, well prepared to weather that storm.
Excellent. Let's go to the UK. Jeremy Hunt and his autumn statement announcing, I think, to the tune of 20 billion pounds for business and personal tax oath. Some say this is desperation because there's a big election next year. What do you make of his statement? I guess what he put forward.
It's very difficult to really divorce this move from it being political, right? At the end of the day, you're seeing, cuts that would essentially free up funds for investment in the economy for the next couple of years. But I think what the Office of Budget Responsibility is essentially saying is that the impact of the monetary tightening is not something that this can erase over a year or two. That impact is very strong, the full brunt of which we're yet to feel. So that's why that office has come out to even significantly reduce, output projections for this year and even next year. This is certainly a good move because, again, inflation has been knocked off its perch of about 11.1% that we had sometime last year before Hunt took over office. It's dropped about 4.6%. Nevertheless, the complete impact of monetary tightening we haven't felt yet, and that would, go a long way to sort of undermine whatever effort that the government is taking right now to sort of reflate the economy. And that's why people are saying, there's an election next year, so this is clearly very likely political. But again, what it does is that going into next year, the Chancellor of the Exchequer might be out of moves from a political standpoint.
And the polls are showing that Labour has a double-digit lead on the Tories. Do you think there could be a sea change next year? You're not a political analyst, but just to get,
It really remains to be seen. The truth of the matter is that the economy has been significantly battered. A lot of the things that the Conservative government is doing now from an economic standpoint really is to narrow that competitiveness gap between the UK and economy and the rest of the OECD countries. That gap has significantly widened. So all of these moves are essentially to basically reduce that gap, put the UK on a more competitive footing, and increase its competitiveness amongst its peers, basically. So really remains to be seen. But what I know again is that people are probably inert at this point and maybe tired of the Conservative government. Really remains to be seen how that plays out.
Let's get to Black Friday, Thanksgiving, it's holidays today. U.S. markets are closed. The National Retail Federation estimating that we're going to get 182 million shoppers this year. I know there's inflation concerns and all that, but so I think it's been dipping in the United States. What do you make of what we could see as far as these projections for U.S. shoppers, retail?
I think that the U.S. consumer remains strong and resilient. We saw the last GDP number, 4.9%, powered by consumers, really. The consumer balance sheet is still quite healthy. Regardless of the inflation that we're seeing, recall that inflation is significantly lower than if you catch your mind back a year ago, right? Yeah, the people are certainly going to be seeking, quite some bargain. But we've seen the estimates or the expectation of consumers rise very strongly. At the end of 2020, it's about 156 million. The expectation right now is going to be over 180 million people that are going to be shopping. So that is a significant improvement. But you can't take away the fact that with the inflationary trend, you could see people going for bargains. But I don't think that it will be a dampener on consumer spending going into the holiday period.
Very, very interesting. Are you going to be doing any Black Friday shopping this weekend?
We're also looking for bargains. So.
Exactly. OpenAI, I have to ask you about what we've seen, the roller coaster there. Their Bloomberg article saying that these people are earning as much as, almost 800,000 if you include all their bonuses and so on. Can you talk about the leverage they had on the board to bring Altman back?
This is just plain old economics, demand and supply, right? Yeah. You've seen that AI field expand very rapidly. We've seen very strong growth in that field. Unfortunately, engineers that have the experience and the competence to really play in that field, they're not much, right? The pace at which the demand for AI and the frenzy around AI has grown, particularly this year, far outstrips, the supply of engineers. And it's not your regular, just software engineers. You're looking at building new AI system, new algo paths, new software and all of that stuff. And the truth of the matter is that you don't even have conventional university training for people to learn these things. Even if you learn it theoretically, you still need time to be able to understand these systems. You need the skill, you need the experience. So that's the issue, really. There's just a shortage of solid AI professionals, and the AI field is growing at a speed that significantly outpaces that supply. So that's the reason this leverage exists. And the truth of the matter is that what this trend is going to obviously portend is that you're going to see a lot of people pivot into that area, and then years down the line, you might have a glut.
Great stuff. Look, as far as what does this mean for the gap between the developed economies and the developing ones, when you look at the skill set and where things are going?
Yeah, so for this, there's something that's called total factor productivity in economics, right? It just talks about how efficiently things are done. And what AI is basically going to do is to help people become more efficient at what they do. So these guys are essentially in the forefront. What it simply means is that the productivity gap between these developed nations and developing nations will just basically continue to widen. Total factor productivity for these countries will continue to improve. Developing nations, really, the onus is on them to get in on this and, get in the game and ensure that, they are able to do things that significantly ramps up productivity in their countries, or else that productivity gap just continues to widen.
Fascinating stuff. Efosa Aluyi, Head of Investment at Sankore Global Investments. Always a pleasure having you. Thank you so much for joining us on the Global Business Report.